Generation Mining, we're developing the Marathon Palladium project. It's in northwestern Ontario. It's mainly a palladium project. It's got about 4 million ounces. This is the measured and indicated portion. 4.2 million ounces of palladium and just over 1 billion pounds of copper and a nice platinum credit. And there's also some gold and silver, which is very important. The gold is because that's what Wheaton is going to be streaming. As far as the people go, I'll just talk a little bit about myself. I've been in this business for over 35 years. 30 years ago this spring, I founded a company called Wheaton River with a partner. Wheaton was a very successful gold miner in British Columbia, operated Canada's first heap leach mine, and interestingly spun out a company called Wheaton Precious. It was called Silver Wheaton at the time, and now it's come full circle. They're financing the Marathon project for us, and Randy Smallwood, the president there, was our chief geologist at Wheaton River back in the day. And we also founded I founded a total of 6 mining companies, 4 of which went into production. So I've done this before, and the other 2 got sold around the time of the feasibility study. And I won't get into all the other people, but we have built a really strong team. I will talk a little bit about our directors. We have 5 independent directors, so good corporate governance in that respect. And these people are all top of their business. Cashel Meager on the top right there is just been appointed president of Capstone Mining. He's an engineer. Paul Murphy is an accountant. He is the chairman of Alamos Gold, and he was the head of the mining group for PricewaterhouseCoopers for the entire Western Hemisphere. Over on the other side, Steve Reifert is a world-class geophysicist. Jennifer Wagner is a lawyer who is a VP at Kirkland Gold, which is, of course, merging up with Agnico right now. And Phil Walford is a reserve geologist who won the Bill Dennis Award at the PDAC last year for the discovery of the Valentine project. So, these are the very, very top people in the mining business, and we were able to attract them to our board based on the management and the quality of the project we have. So location is huge in our business. We are in northwestern Ontario, which is one of the more active areas for mining in Canada. There's a couple of mines in this picture that are under construction. There's a few more at the feasibility stage, and as well as ours. As far as infrastructure goes, I don't think it could get much better. The blue area is our property. The Marathon deposit is the one we're putting into production. We've got the Trans-Canada Highway coming through the property. We've got the CPR rail. We've got an airport on the property. We've got, and very importantly, we've got the town of Marathon just to the south. And we've also got this power line coming up from the southeast. And that is being upgraded to a 230 kilovolt power line. We're going to be able to get all of our power off the Ontario grid. For example, Hard Rock to the north of us has to generate their own power using natural gas, so not a great carbon footprint. We're going to the Ontario power grid is now 96% carbon free, so that really bodes well for our ESG going forward. So we finished a feasibility study about 10 months ago. And it looks at a 13-year mine life, producing about 245,000 ounces of palladium equivalent a year. If you put that into gold, it would be about 300,000 ounces of gold equivalent. And the capex is $665 million US, with an all-in sustaining cost of just over $800 an ounce. And palladium is trading just under $2,000 an ounce currently. The base case IRR on this project is 30%. And the after-tax net present value is just over $1 billion, and those are using substantially lower than current prices. If you put today's metal prices into the feasibility study, the net present value would be about 1.6 billion Canadian dollars, and we're trading at a market cap of right now about $160 million. So about 10% of today's net present value of the project. Base case payback is 2.3 years. With the recent Wheaton deal, that actually goes down to 1.75 years. And at today's spot prices, it'll be a bit lower than that. So Joe mentioned that we did this deal with Wheaton, and they're going to pay us $240 million to stream our gold and about a fifth of our platinum. which is equates to about 4.8% of the total mine revenue. And they're giving us $40 million of that up front, and the rest during construction. That $40 million will allow us to do all the detailed engineering and start putting some down payments on equipment, because we want to start construction of the mine this fall. The deal with Wheaton increases that internal rate of return, by the way, to 38%. Our next step in financing is to put together a debt package. We're working with Endeavour Financial on that. I've been working with Endeavour for about 25 years on various mining projects, and we're negotiating right now with banks and smelters and a couple of private equity firms. And the final debt package that we put together, and that's a big range, $400 to $500 million. If you're at the lower end of the range, it'll be with lower interest rate, and if we're going to go at the higher end of the range, it'll be some of these private equity companies that want a little higher interest. But our payback is short, so we're not really afraid of that. And that final debt package will determine what equity we're going to need to put to this project, and that equity could come from either bringing in a partner, or say like a private equity company for 10 or 20% of the mine, or selling shares through the market. And those selling the shares, that could be preferred. It could be there's a lot of different creative things happening in the mine finance business these days, and we're looking at all of them. So if you have a look at the cash flow from this project, you saw the CapEx, $665 million. We get most of that back in the first 2 years. That's why we got the quick payback, but it's got a nice payback, or nice cash flow year after year after year. And these are all base case prices, so $3.20 copper and $17.25 palladium. We've designed the mine to get most of the palladium out in the first half of the mine life, and the reason for that is because, as you know, cars are going electric. They're going to need less palladium in the automobile industry, although we think that rollout is going to be slow, simply because hybrid cars need more palladium than a regular car, and hybrid cars continue to really vastly outsell electric cars in the world right now. Copper, we're saving a lot of the copper for the second half of the mine life, because if electric cars do get popular, then there's going to be a real copper crisis coming, sometime towards the end of this decade, if the electric cars really do ramp up. And the other thing that has to happen is the grid has to get greener. There's no point in having electric cars if you're burning coal to power them. So that's going to take, that redoing of the grid is going to take another immense amount of copper. Interestingly, on the palladium price, so at today's palladium price adds about $300 million to the net present value. But if you knocked $750 off of today's palladium price, you've still got that 20% IRR that you really need in order to justify building a mine. And another thing that's happening is the copper. The copper at today's price adds about $300 million to the net present value as well, another $300 million. And at $4.50 copper, copper here covers all of our operating expenses. So the palladium all comes out for free, as well as the gold and the platinum and the silver. So it's very, very great in terms of a byproduct. We've also been putting together the team to build the mine. Some of these people mostly are not full-time yet, but they're consulting with us and will be coming on to build the mine. Steve Haggerty was a former VP at Barrick and a senior guy at Homestake and Corona and Teck before that. Paul Murphy, this is a different Paul Murphy than the one on our board. He's an engineer. He was with G Mining. In fact, he was the quarterback of the feasibility study that G Mining did for us, and when he finished it, he left them and joined us, which shows you what he thinks of the project. And G Mining, of course, you may know them. They did the Fruta del Nor mine for Lundin Gold. They did the Detour Lake expansion in 2015. They're big open pit mining people, and they've done this before. And Paul was previously at Centerra and also at IM Gold, where he built about 5 mines for them. And I won't get into all the different people. We've also got a very strong ESG team Catherine Moffat, a former Detour Gold. Jeremy Dart just joined us. He came over from Barrick at Hemlo. We don't even have to move him. He already lives in the town of Marathon. I won't talk too much about Palladium. This is on our website, but basically Palladium has been in deficit for the last 10 years, and it will be in deficit for the foreseeable future, in our opinion, provided the car makers get back to making cars, which it looks like they're starting to do. And as that happens, we think that there's a chance for another run up in the palladium price. Joe mentioned our carbon footprint. So if you look at the mines in Canada, the copper mines, this was a company called Scar and Associates out of London, England, and they've put us as the second lowest carbon footprint of any copper mine. That's based on our copper equivalent in Canada. So very, very clean. And that's a lot largely due to being on the grid in Ontario. In terms of world, we're in the bottom 4% of carbon output to produce a ton of copper. The average is about 4.5 tons of carbon per ton of copper. We're at 1.5 tons. If this mine was in production today, it would be the 7th largest precious metal mine in Canada, so it's some pretty good company. Permitting, always the big question in our business. So we have been working really hard for the last 2 years on permitting. We reached what's called sufficiency in December. Sufficiency means that the government has basically no more questions. They have all the information they need. And the next step is the public hearings, which are going to start in March. They got delayed by COVID by a month, but they're still going to start in March. They're now going to be virtual. And then and after that, they have the Joint Review Panel has 90 days to give the recommendation to the government. This is an independent panel that was appointed by the province and the federal government together. And then the ministers, federally and provincially, have 120 days to make their decision. So the good part about being in the process we're in, and we're the only mine in Ontario that's ever gone through a joint review panel process. The good thing about it is that the days are all defined. And so it's not something that the government can sit on like they have in the past for some other mining projects. That said, they could find ways to delay it. They seem to be good at that. But nevertheless, we're looking forward to getting our answer on this mine sometime in the fall and beginning construction very soon after that. The permits, the provincial government has allowed us to apply for the permits in absence of the EA approval, but they can't issue the permits until the EA has been approved. So we're looking forward to having all of this happen this fall. And this is a project that we've only had for less than 3 years. So we've done a lot to get it this far in such a short time. What else are we doing? Well, right now we appointed Wood Engineering to do the detailed engineering, and they started that last fall, and they are going to be working through to the summer. We want to have 75% of that started before construction. We're at the table with the 2 First Nations that we need to talk to. One of them we already have a letter of intent with. The other one, the letter of intent is in draft form. It's coming along. Should be signed imminently. Mine financing, I mentioned we have the Wheaton commitment, and then we also are now working on the bank financing. And we're hoping to begin construction before the end of this year. This is the town of Marathon. Down at the bottom here, here's the main zone in the W horizon that we're going to be mining. And we've got all of these targets. These are all palladium and copper showings on surface that have had very little exploration. We have 2 other deposits on the property as well that could extend the mine life 6 or 7 more years, and then a lot of exploration. This whole the strike length of the mineralization here is about 40 kilometers. So just to finish up, we've got 171 million shares outstanding. That's after we issued 21 million to Sibanye, our partner, who we made a deal to buy out in December. And as I mentioned, this shows a share price of $1. So our price is 90 cents. We've got a market cap of about $160 million, which is less than 10% of the current net present value of the project. And we've got some pretty good list of shareholders: Lucas Lundin, Eric Sprotto, Cisco, and Sibanye Stillwater.